Hello guys, welcome back to another great episode. This is the 47th episode of building a logistics trucking business from scratch. I am more than excited about starting this journey. It has made me have a different perspective on life. Thanks so much for being with me throughout the process. It really is a great feeling to have you with me along the journey. I hope you will learn a lot. Today, I will be transporting pressure tanks to Cardiff. Along the way, I will be talking about loans. Don't forget to like and subscribe for more amazing videos like this. Have fun! Borrowing is often a fact of adult life. Almost everyone needs to take out a loan at some point. Maybe it's for a new home. Maybe it's for college tuition. Maybe it's to start a business. Whatever the reason you have to borrow money, professional financing options are many and varied nowadays. They range from traditional financial institutions, like banks, credit unions, and financing companies, to internet-age creations, like peer-to-peer lending, P2P, from public agencies to your own personal 401k plan. I'll outline some of the more popular lending sources, explaining how they work and reviewing the pros and cons associated with each. Banks. Banks are a traditional source of funds for individuals looking to borrow. By definition, that's what they do. They take in money, deposits, and then distribute that money in the form of financing products, like mortgages and consumer loans. Although banks may pay a little interest on deposited funds they take in, they charge a higher interest rate on the funds they give out, as loans. This spread is essentially how they make their profit. Banks offer a variety of ways to borrow money: mortgage products, personal loans, auto loans, construction loans, and other financing products. They also offer opportunities for those looking to refinance an existing loan at a more favorable rate. Pros and cons of borrowing from a bank. Many people find that doing business with their own bank is easy. After all, they already have a relationship and an account there. In addition, personnel is usually on hand at the local branch to answer questions and help with paperwork. A notary public may also be available to help the customer document certain business or personal transactions. Also, copies of checks the customer has written are made available electronically. The downside to getting financing from a bank is that bank fees can be hefty. In fact, some banks are notorious for the high cost of their loan application or servicing fees. In addition, banks are usually privately owned or owned by shareholders. As such, they are beholden to those individuals and not necessarily to the individual customer. Finally, banks may resell your loan to another bank or financing company, and this may mean that fees, interest rates, and procedures may change often with little notice. Credit unions. A credit union is a cooperative institution controlled by its members, the people that use its services. Credit unions usually tend to include members of a particular group, organization, or community to which one must belong in order to borrow. Pros and cons of borrowing from a credit union. Credit unions offer many of the same services as banks. But they are typically non-profit enterprises, which helps enable them to lend money at more favorable rates or on more generous terms than commercial financial institutions. In addition, certain fees, such as transaction or lending application fees, may be cheaper or even non-existent. On the downside, some credit unions only offer plain vanilla loans, or do not provide the variety of loan products that some of the bigger banks do. And of course, you have to join a credit union and open an account with it before you can borrow money from it, though often, you can do so with a very nominal amount. Peer-to-peer lending, P2P. Peer-to-peer, P2P, lending, also known as social lending or crowd lending, is a method of financing that enables individuals to borrow from and lend money to each other directly, without an institutional intermediary, like a bank or broker. While it removes the middleman from the process, it also involves more time, effort, and risk than going through an official financial institution. With peer-to-peer lending, borrowers receive financing from individual investors who are willing to lend their own money for an agreed interest rate. The two link up via a peer-to-peer online platform. Borrowers display their profiles on these sites, where investors can assess them to determine whether they would want to risk extending a loan to that person. Pros and cons of borrowing through peer-to-peer lending. A borrower might receive the full amount they're asking for or only a portion of it. In the case of the latter, the remaining portion of the loan may be funded by one or more investors in the peer lending marketplace. It's quite typical for a loan to have multiple sources, with monthly repayments being made to each of the individual sources. For lenders, the loans generate income in the form of interest, which can often exceed the rates that can be earned through other vehicles, such as savings accounts and CDs. In addition, the monthly interest payments a lender receives may even earn a higher return than a stock market investment. For borrowers, P2P loans represent an alternative source of financing, especially useful if they are unable to get approval from standard financial intermediaries. They often receive a more favorable interest rate or terms on the loan than from conventional sources too. Still, any consumer considering using a peer-to-peer lending site should check the fees on transactions. Like banks, the sites may charge loan origination fees, late fees, and bounced payment fees. 401k plans. If you need a loan, why not borrow money from yourself? Most 401k plans, along with comparable workplace-based retirement accounts, such as a 403b or 457 plan, allow employees to withdraw funds in the shape of a 401k loan. A permanent withdrawal from a 401k incurs taxes and a 10% penalty if you're under 59.5 years old. But you avoid that with a 401k loan, since you're technically taking out the funds temporarily. Most 401k allow you to borrow up to 50% of the funds vested in the account, to a limit of $50,000, and for up to 5 years. Because the funds are not withdrawn, only borrowed, the loan is tax-free. You then repay the loan gradually, including both the principal and interest. Pros and cons of borrowing from a 401k plan. The interest rate on 401k loans tends to be relatively low, perhaps 1 or 2 points above the prime rate, which is less than many consumers would pay for a personal loan. Also, unlike a traditional loan, the interest doesn't go to the bank or another commercial lender, it goes to you. Since the interest is returned to your account, some argue, the cost of borrowing from your 401k fund is essentially a payment back to yourself for the use of the money. And, since the money that you've contributed to the plan is technically yours, there are no underwriting or application fees associated with the loan either. Bear in mind though, just because you're your own lender doesn't mean you can be sloppy or lazy with repayments. If you don't pay on schedule, and the IRS finds out, you could be considered in default, and your loan classified as a distribution, with taxes and penalties due on it. Another important, long-term consideration: if you remove money from your retirement plan, you lose out on the funds compounding with tax-free interest. Also, most plans have a provision that prohibits you from making additional contributions until the loan balance is repaid. All of these things can have an adverse effect on your nest egg's growth. So, borrowing money from your 401k is usually seen as a last resort. Certainly, it's not a loan to be undertaken lightly. Credit cards. Anytime you use a credit card, you are in a sense borrowing money. The credit card company pays the merchant for you, advancing you the money, so to speak, and then you repay the card issuer when your card statement comes. But a credit card can also be used not just to purchase a good or service, but for actual funds. It's called a cash advance. Pros and cons of borrowing through credit cards. If an individual needs to borrow a small amount of money for a short period, a cash advance on a credit card may not be a bad idea. After all, there are no application fees, assuming you already have a card. For those who pay off their entire balance at the end of every month, credit cards can be a source of loans at a 0% interest rate. On the flip side, if a balance is carried over, credit cards can carry exorbitant interest rate charges, often in excess of 20% annually. Also, credit card companies will usually only lend or extend a relatively small amount of money or credit to the individual. That can be a disadvantage for those that need longer-term financing or for those that wish to make an exceptionally large purchase, such as a new car. Finally, borrowing too much money through credit cards could reduce your chances of getting loans or additional credit from other lending institutions. If used responsibly, credit cards are a great source of loans, but can cause undue hardship to those who are not aware of the costs. They are not considered to be sources of longer-term financing. However, they can be a good source of funds for those who need money quickly and intend to repay the borrowed amount in short order. Margin accounts. Margin accounts allow a brokerage customer to borrow money to invest in securities. The funds or equity in the brokerage account are often used as collateral for this loan. Pros and cons of borrowing through margin accounts. The interest rates charged by margin accounts are usually better than or consistent with other sources of funding. In addition, if a margin account is already maintained and the customer has an ample amount of equity in the account, a loan is somewhat easy to come by. Margin accounts are primarily used to make investments and are not a source of funding for longer-term financing. That said, an individual with enough equity can use margin loans to purchase everything from a car to a home. However, should the value of the securities in the account decline, the brokerage firm may require the individual to put up additional collateral on short notice or risk the investments being sold out from under them. Finally, in a market downturn, those that have extended themselves on margin tend to experience more severe losses because of the interest charges that accrue, as well as the possibility that they may have to meet a margin call. Public agencies. The U.S. government or entities sponsored or chartered by the government can be a terrific source of funds. For example, Fannie Mae is a quasi-public agency that has worked to increase the availability and affordability of home ownership over the years. The pros and cons of borrowing through public agencies. The government or the sponsored entity allows borrowers to repay borrowings over an extended period. In addition, interest rates charged are usually favorable compared to private sources of funding. On the other hand, the paperwork to obtain a loan from a quasi-public agency can be daunting. Also, not everyone qualifies for government loans. There can be restrictive income and asset requirements. For example, with regard to certain Freddie Mac mortgage offerings, an individual's income must be equal to or less than the area's median income. Financing companies. Financing companies, aka finance companies, are outfits dedicated to lending money. Unlike banks or credit unions, finance companies do not accept deposits or provide other financial services or products, safe deposit boxes, credit cards, etc. They just routinely make loans to individuals or businesses needing funds. In the case of consumers, they usually provide loans to purchase big-ticket goods or services, such as a car, major appliances, or furniture. Some specialize in medical or healthcare costs. While some lenders make longer-term loans, most financing companies specialize in short-term loans. Often they are connected to a manufacturer or larger company, serving as their financing arm, so to speak. Some of the best-known finance companies are associated with particular car makers, like Toyota or General Motors, and make auto loans or auto leases. Pros and cons of borrowing through financing companies. Financing companies usually offer competitive rates, though a lot depends on your credit score and financial history, and the overall fees can be low when compared to banks and other lending institutions. In addition, the approval process is usually completed fairly quickly. Plus, there's the convenience factor when the finance company is connected to the retailer or manufacturer whose products you're buying. However, financing companies may not provide the same level of customer service or offer additional services, such as ATMs. They also tend to have a limited array of loans. It's also important to note that finance companies are licensed and regulated by the state in which they operate. They are not subject to federal oversight and rules, the way banks and credit unions are. In short, they are less regulated and have more liberty in adjusting their rates and altering their terms. Thanks for listening. I hope you've learned something. We have finally arrived at our destination. Thanks a lot for being with me throughout the journey, and I hope you've learned something about loans. My client has paid me €5,891. Not a bad amount. Until next time, bye.